Alright, so look, in this video, I'm going to teach you about the truths behind liquidity. I'm going to show you how institutions and banks use these methods to try and trap retail traders in trades or to swing them out of positions right before the big move occurs. So I'm going to teach you about three main types of liquidity that I use in my trading. The first is daily chart liquidity pools. The second is Asian session liquidity. And the third and final one is previous session lows liquidity. Alright, the first one I'm going to show you about, and I'm going to make the concept really easy, is daily chart liquidity pools. What this basically is this is where institutions are looking to position, and this is where a majority of stop losses are placed. So, for example, here, right this level here, at this moment in time, when price was trading in this range here, liquidity was building up. We had a shift of market structure here, and as you can see, market changed to the downside. Where was price targeting? Price was targeting the build-up of liquidity here. How do we know there's a build-up of liquidity underneath this level? The reason we know this is because there are a bunch of spikes. These spikes tell us that there's buyers here. So it got bought up here, it got bought up here, it got bought up here. And what this tells me is, if you take a look at the way the chart looks, it just seems that there's a bunch of buyers underneath here. All the people who bought here all have their stop losses positioned here. So let's say, for example, everyone had their stop losses positioned here. And then what happened as price approached it? We started to have even more of a build-up of liquidity. What this means is price was targeting this area, but it didn't reach there up until here. And as you can see, we swept liquidity, and then boom, price rallied higher. Funny enough, price rallied on election day. But we had to sweep liquidity first. Why? Because institutions, they place very large orders. So they need liquidity to place large orders so that they get filled at the price that they want. What that means is if an institution wanted to place a buy order without having a lot of liquidity, they would move the price higher in order to place the order. And what that basically means is they would get filled at a higher price, not the price that they anticipated. So they need to target liquidity before they can get an entry into the market. This also happened, a build-up of liquidity also happened here, first week of January, or second week of January, I should say. We had price coming down here. We had a market structure shift up here. Where was it targeting? It was targeting this level. Well, actually, no, it wasn't targeting this level. It was targeting this level here. It came. And then when we were trying to confirm the downtrend, or continue the downtrend, I should say, the reason I knew this was a build-up of liquidity is because we had the buyers positioning here, here, and here, but price started to trade in a range slightly above this area, telling me that all the buyers decided to position here. All of these people became liquidity, exit liquidity for people who wanted to look for buy entries further. What happened? Price pulled back into it, swept liquidity, and rallied higher. And we had a massive rally higher. Let me see if I can find one more example of daily liquidity pools to show you guys how this occurs in price for the big moves that occur on the daily chart. And these are the type of trades that I'm looking for when I'm trying to position for swing trades. Let me see if I can find one more example of this. So perfect, just right here. What we have here, we have a bunch of buyers entering the market at this level, right here, and we have another set of buyers entering the market at this level, right here. So this is a build-up of liquidity. What happened here? After price rallied higher, we had a market structure shift here, and then where did price come to target? Let's have a look. It's the same level. It's the build-up of liquidity. So as you can see, liquidity pools are important for institutional investors before they can get into their big market rally moves. And once liquidity was swept and we had a market structure shift, liquidity allows institutions to position right in that zone. So that's the first example of it. If you want to go into the charts and try and find more and more examples of this, it would help you to build your confidence in, trying to understand liquidity pools and daily liquidity pools essentially. The next type of liquidity I want to talk about, this one's really important for my method of entry, is Asian session liquidity. And the reason Asian session liquidity is important is because Asian session, the market institutions tends to use Asian session liquidity on intraday sessions in order to position into the market. The way this works is basically they target the Asian session lows. I haven't done much backtesting about this, but I'm going to have a look and see if I can find any examples of this. But basically, the low of the market during the Asian session is usually targeted. So let's have a look. Here on Wednesday, if we have a look at where the market was lowest for Wednesday, it was right here. That's where it opened. And then during the session, during New York session, price came down, took liquidity here, and then bounced off it and continued higher. Asian session liquidity is a very important area for institutions. So a method that I use to enter the markets is when I see Asian session liquidity get swept, I have my order there, I have my 250 pip stop loss, and then I'll enter the market, and I'll hopefully just rally, join the market at this area where institutions are always also entering the market. It's really important that you consider, why is it that you always get stopped out of the market before the move happens? It's because institutions are targeting your stop losses as liquidity. Your analysis is right, but institutions are targeting your liquidity. So you need to be able to think like the institutions. Think the way these big banks are thinking. Once I understood the concept of liquidity, my trading changed for the better. I became more accurate in my predictions, and I was a lot more patient with my entries. There's something called a Tuesday sweep, which not many people know about. But basically, institutions will allow for traders to position on a Monday, and what they'll do is they'll target Monday session lows, and then after they swept Monday session lows on Tuesday, it's called the Tuesday sweep. After the Tuesday sweep occurs, the main move for the week will happen. So if you take a look at the weekly chart, usually what would happen is the Monday liquidity will get swept before making the low of the week on Tuesday, and then price will rally higher. I'm not quite sure if that happened this week. Not quite this week. Oh no, it did. Look, so it didn't happen this week, but usually on a Tuesday you'll see the market sweep Monday's activity. As we see here, this is Monday. On Tuesday we see it get swept, and then price goes higher on Wednesday, Thursday, Friday. I want to see if I can find one more example for you. Not quite. But do your own backtesting and have a look at this, and you'll see that there's some consistency in the Tuesday sweep. The final one I want to talk to you about is also previous session liquidity lows. Obviously, it depends on the trend of the market, but the previous session, the low for the market, the previous day, tends to have a build-up of liquidity, and this happens on all charts. What this looks like is stuff like this. So people from the previous day, these lot who bought on this day will get swept. Their stop losses will get swept, and that will be the fuel for the rally on the next day. And you see this happen countless amount of times in the market. So it's really important that you try and understand how liquidity works. I've shown you three main ones. The main one that I think is important for swing traders is obviously daily session liquidity pools, where there's a build-up of liquidity occurring at a level, and then the liquidity gets swept. And once it gets swept, price rallies to the opposite side. That's the first and most important liquidity pool. Daily chart liquidity pools are the most important one, followed by Asian session liquidity, which is just the low of the Asian session. Price targets it, and then after it gets targeted, buyers rally into the market after targeting the low of the Asian session, which is right here, and then market goes higher. And then the third and final one is simply just the low of the previous day. And the more you look at your charts, the more you understand that this is really important, understanding where liquidity is. Because if you can know when not to position into the market, when to wait, you'll be able to avoid a lot more losing trades. So this video, I tried to explain it as best as I could. I'd advise you, watch some of the other videos on my channel to try to get a broader understanding for how I swing trade and how I position into the market. But it's very stress-free. It's based on liquidity. It's based on fair value gaps. It's based on institutional order flow, market structure shifts, and it's very, very stress-free. So that's why I really enjoy the way I trade.